I believe that between now and the end of the year, that Bitcoin will more and more delink from risk assets. I think that there is, and I do a show every week where I talk with Mike McGlone from Bloomberg. He is extremely bearish on the economy, thinking that the contraction in bank lending is going to be rippled throughout the economy, and that real economy is going to collapse or at least contract. I think that's probably right.
We're here with Dave Weisberger, CEO of CoinRoutes. Dave, welcome to my show, The Dave Lynn Report.
Well, thanks for having me, Dave.
Dave squared. So let's talk about, first of all, this banking crisis. Now, you've had a storied career on Wall Street. You had senior positions at Citibank as well as Morgan Stanley, and you've been a global leader in developing capital markets and market-making systems. So walk us through why banks are failing.
Well, the one-word answer is confidence, but obviously there's more to it than that. So in the balance sheets of banks, they are loaning, and there have been lots of really good explanations about this. I would recommend your readers read Matt Levine's column from yesterday. He does a great job, but let me boil it down. Banks take deposits that they believe to be sticky, i.e. they provide lots of customer service and customers put money with banks. They get below market interest rates for doing it, but ease and convenience. It used to be the interest rate they would get was relatively close to market interest rates. But if you look at a chart of the average savings account rate compared to the average rate in, for example, 3-month T-bills, that spread has widened to historic levels. And so monetary incentives to hold money in banks is down. At the same time, they had all of these deposits before the Fed started hiking rates, and they bought treasuries in order to, make money because they would get paid 2.5% back then. It was a year and a half to 2 years ago. And they have this on their books. Now, banks don't have to disclose the amount of money that their portfolio is losing if, in fact, they believe they're going to be able to hold bonds to maturity. So you have on the balance sheets of banks a massive black hole after Powell has raised rates by the better part of 5%. So effectively, you have a hole that I've seen estimates at the 600 billion level. And if you expand that to non-government securities, it's probably larger. So there's a big hole in bank balance sheets if people withdraw money. Now, I don't know about you, but one of the things that happens with human beings is if we hear that, no one wants to be the last person to withdraw money from a bank that might be failing. And so you get, in the case of Silicon Valley Bank, a run on the bank. In the case of First Republic, a run started and they called in JP Morgan, just like they did with Bear Stearns in the start of the global financial crisis back in 2007, to kind of rescue the situation. But bank balance sheets have a huge hole. Unfortunately, like the knife salesman on late night TV, there's more. A lot of banks have significant exposure. And if you look, regional banks have dramatically more exposure to commercial real estate backed loans as collateral. Now, you don't have to be a rocket scientist to look at commercial real estate as an uh-oh kind of flag. Occupancy rates in the major cities for businesses are under 50%. And despite what was thought, the expectation now is that occupancy rate's not going to increase. Now, what does that mean? Well, it means that as leases come up for renewal, they're not going to get renewed or they're going to be cut back and leverage is going to happen. That's going to impair the value of collateral. And that directly impacts regional banks far more than the big money center banks, because it just happens to be that's where that impaired collateral is. So you have a double-barreled effect. You have bonds dropping and you have lowered value of collateral. That speaks to a very toxic mix. And so there's lots of people talking about the Federal Reserve needing to effectively guarantee all bank deposits. They sort of did that with the BTFP program that came out after Silicon Valley Bank, but it's clearly not enough. And that is trillions of dollars of additional money that could enter. So that's sort of what's going on with the bank situation right now. Why is there big concern? Well, the big concern is regional banks are the engine for small to medium-sized companies to finance activities. So if we see a dramatic slowdown in bank lending from the regional banking side, you could see huge knock-on effects throughout the economy going forward. And so that's why people are very much concerned about it.
I want to come back to this knock-on effect that you're talking about. You held senior positions at many big banks, like I mentioned, Citigroup throughout the 2000s for about 7.5 years, Solomon Smith Barney before that, and then Morgan Stanley. And you were mostly on the market-making side. But comment on this, please, Dave. Why is it that we're seeing regional banks fail and not yet the big banks? In the sense that, do you know what it is that's different between the big banks and the regional banks and how they manage risk?
Well, the last question, I'm not sure is relevant, but let's just go to it. There are three reasons. We'll start with the last question. The big banks are all subject to, if you're over, I think it was $250 billion in assets is the threshold now, you're subject to slightly more need for under Sarbanes-Oxley and other banking regulations put in after the GFC, your stress tests are going to be a little bit tougher, et cetera. It is unclear that any of those would have detected these problems because those stress tests don't force you to write down or take mark-to-market losses on your portfolio. But there are two huge differences with the big money center banks. Big difference number one is the way it's treated. The vast majority of people believe those banks are too big to fail, and the government has their back. And in order in exchange for that, they also have the ability to borrow directly from the Fed, and they can do things to offset that risk. Sure, they probably do have tighter risk control to some degree, but I think it's more the implied put from the federal government. The second is the nature of the collateral that they take and the businesses that they're in. As I said, it turns out that commercial real estate is a significantly larger percentage of regional bank balance sheets and regional bank loan portfolios than the commercial banks. The too big to fail banks are all dramatically more diversified globally, dramatically more diversified because of their footprint. So there is much more risk on the regional side perceived because there's no perception that the government will bail them out, which frankly, despite that was exactly what we were trying to avoid in the GFC. It seems like we are getting to the point where that implied put is incredibly valuable. And so you're seeing both of those things at play.
Evaluate this next statement, please. Agree or disagree. If we continue to get consolidation, which is to say that the big banks buy out the regional banks that are distressed, then the banking sector overall will be all right, and there will be no real collateral damage to other sectors of the economy.
I violently disagree with that statement. I think that it is a palliative, but it will create issues. Big banks have there are lots of small to medium-sized businesses out there. And despite the commercials from all the major banks, there is a reason why the regional banks are the engine for much of small to medium-sized businesses, because there's more of a personal touch, there's more knowledge of local geographies, there's more access to capital. That is important. And so if you want an economy that's dominated by big multinational companies, by all means, nationalize the banking sector and have more and more consolidation. If you want an economy that's healthy, and we all know that small business is the engine of growth in most economies. In fact, you and I are both running startups. I would hazard a guess that neither one of us is relying on big money center bank loans to finance our businesses. The reality is small business is the engine of growth, has been for the American economy. It's not just the American economy, it's the global economy. So I do think that there is risk to the underlying economy by nationalization. It also dramatically increases centralized power. What is fascinating, and we haven't talked about it yet, is that level of centralization is going to expose a lot of the rationale that people in my sector, in the crypto sector, care about, which is the benefits of decentralization. The more the regional banks get flushed and the banking system gets more centralized, it will make an even starker comparison toward less centralized ways of finance.
I do want to talk about your story and why. I'm always fascinated by why leaders in TradFi move to the crypto space, but we'll get to that. But first, I want to talk about these knock-on effects that you brought up. Let's focus on commercial real estate first. So obviously, this is going to take some time to trickle down, but walk us through what's going to happen to the commercial real estate sector after this banking crisis unfolds.
Well, I mean, certainly as the Fed has tightened rates, that's not helping. right? Because as just for the benefit of your viewers, there is a very clear mathematical reason why when rates rise, the prices of bonds fall. It's a totally inverse relationship. It's just pure math. Now, we're talking about it on the federal side, but if the cost to borrow and the cost that it requires for backed bonds is impacted as well by rate rises. So there's that. Rate rises have an indirect effect of slowing economic activity, and that has a direct bearing upon the value of collateral like commercial real estate as well. But the more interesting thing is we have yet to feel the full impact of the trends that started with the pandemic and the trends that have started with, well, let's just say major cities where companies are moving. So there are cities, San Francisco, Chicago, New York, and to some degree, LA, Boston, and others, where occupancy rates are dramatically lower and don't show any signs of really increasing. Instead of an occupancy rate in the 90s, we have occupancy rates in the 50s. So when that happens, one has to ask yourself, well, what will be the impact? What's important, and the reason it hasn't shown up dramatically yet, is real estate leases are long term. People don't lease something for a year. They lease it for 3, 5, 10, or longer. Now, as your occupancy rate decreases, your need for property decreases, you try to sublet it, you try to do all sorts of things. But at the end of the day, you're still paying rent on the bonds that are backing the commercial real estate. As those leases mature and can't be rolled over, and occupancy and new lease rates, vacancy rates increases, that will impair the collateral. And if you look at what was said about, for example, Signature Bank, where a lot of people in crypto have alleged that, what happened had to do with their Signet platform. And there might be truth to that. That's a totally different conversation. What's clear is their balance sheet was dramatically impacted by the thought and by impaired collateral on the corporate real estate side. And so it's really that impairment that has people significantly concerned on the regional banking side.
And so overall, then, let's close off on the real estate sector. Is this going to have a material impact on the residential side?
I don't think that they're related except in specific markets. I mean, obviously, if people flee, as people flee San Francisco, companies flee, people won't demand commercial, residential real estate there as much, but it still seems to be holding up. Same could be true in New York, although we have not seen any impact on the residential real estate market there. It's kind of mystifying to me, as 300,000 people have left the city, all fairly affluent, and gone to places like we have. And you can see behind me, we moved CoinRoutes down from New York to Miami. And, we are huge fans of the business climate down here, led by Mayor Suarez and others. So it's been a great decision for us. Lots of companies doing similar things. And now we have Chicago, where Citadel is moving to Miami, and other firms now have to start looking at it, considering what's going on in that city. So, but it hasn't happened yet. And I am not an expert in the residential real estate market, I will tell you.
Well, take out your crystal ball for us for just a minute or two. What is the banking sector going to look like a year from now? How many more banks? Well, not how many, but nobody knows. But what is the overall size of the regional banking sector in terms of market cap relative to today? How many more consolidations are we going to get? How will regulations change? Yeah.
Yeah, my personal view is the Fed and the government's going to blink. I think they're going to, they may make Yellen a scapegoat. They may not. I'm not politically adroit enough to know how it will take place, but I will be extraordinarily surprised if there's not an intervention into the system to say, okay, we're going to guarantee deposits and try to stem the bleeding, because I think it's pretty well known how important that sector is. So while the equity market cap might very well have significant more to go, just as a general point of, are they overvalued given where they can go? I think they're going to do a lot and take a lot of effort to try to hold or stop the run on deposits at these banks, because I think it's really important for them to be able to operate. So I don't want to put a number on it, but I suspect that the market pricing in 75 basis points of rate cuts by the end of the year, and people starting to price in federal bailouts or at least guarantee funds to increase, I think that's more likely than a significant flight. Because if they don't do that, the value of that sector could drop 50% over the next year, which is a catastrophic number.
Didn't Janet Yellen already pledge to backstop any deposit funds?
Not really. They've been kind of mealy-mouthed about it in terms of what they said. They've kind of implied that they're going to do so, and they certainly have given the ability for federal debt, that's the BTFP program. They're saying if you own US Treasuries that you bought for $100 and are now worth $60, you can pledge that and get $100 of good collateral. So that they have done. But that's not the same thing as guaranteeing people's deposits when there's worries that there's knock-on effects going throughout the economy. So there is definite concern.
Okay. For those people involved in the capital markets, you're well positioned to answer this as well. Do regional banks have a significant impact on market making?
I don't believe so. I think that it's much more on lending to smaller and intermediate sized businesses is where the regional banks tend to be.
Okay. I'm curious to get your story. Sum it up for us. Why did you move from, a well-positioned career in TradFi to the crypto side? You very well may have stayed on the banking side even today, but now you're at CoinRoutes. Why?
Right. So the answer is actually, it's kind of a fun story. So I was leaving IHS Markit as global head of market structure there. And I had a very attractive package to leave, and so I could take my time. And so I was doing some consulting, working with a company called Viable Markets, Chris White, learning about fixed income markets. I always love learning about new things. And about a couple months after that, my son, Ian Weisberger, came to me with the idea. He said, look, there's this market called crypto, Bitcoin, Ethereum, and others, which is completely fragmented, and people are going to need help in navigating and investing in those markets. And at the time, I didn't know. I knew what Bitcoin was kind of marginally, but I certainly hadn't read the white paper. I didn't really know very much about it. And I had no clue what Ethereum was, or certainly nothing else. And so I started investigating it. And the fact of the matter is the market structure in digital assets and crypto is extremely interesting. There are major differences with other asset classes. And in fact, he was right. The fragmentation is dramatic. And so it felt like it was a really good opportunity to build something that would have product market fit. And considering that I was in a good situation, it felt like the right time to do it. So Ian and I sat together. We designed our MVP. We applied for a patent, which interestingly enough was just granted a month and a half ago for a distributed smart order routing interface, architecture, which is far better for crypto for a lot of reasons. It allows us to be a low-cost provider for institutional platforms, and it allows us to handle all of the data significantly better on a more efficient basis for our clients. Crypto, just so you know, the average amount of data is dramatically more. So, for example, in an equity, if you look at IBM or Microsoft, within 10 discrete price levels on exchanges of the best bid and best offer, so where the market is actually concentrated, that's about 90% of all the liquidity that anyone really cares about. In Bitcoin, if you want to know how many price level exchange combinations exist within, say, 1% of the best bid and best offer, that number is going to reach into the thousands. So it's literally 2 orders of magnitude more fragmented. And there's a dramatically different sort of issue in equities, regardless of where you are. The exchanges that you can use. In crypto, depending on your geography, even down to the state level in the United States, there are different available markets to you. So it is a more fragmented, more difficult to navigate market with more, I hate to use the word arbitrage, but we'll use that word just so people can understand it. And it felt like algorithms that would allow people to buy lower and sell higher would have a big take up. And in fact, that's what we base CoinRoutes upon. We provide best execution in a variety of ways to our clients. And so that's how we got to where we are today.
You said in another interview that Bitcoin threatens the ability to print money. What did you mean by that?
Great. Now, that's one of my favorite topics. So it doesn't threaten anything right now. In the long run, it will. So if you looked at Alan Greenspan over his years, he always passionately looked to see what the price of gold was, because gold was the original, for thousands of years, the benchmark upon which all currencies were measured. And there are lots of people who will say that gold is actively manipulated down. We could talk about it, but at the end of the day, it still is something that's a benchmark for what people would call monetary inflation. The fact is, unlike gold, which is really hard to measure, which isn't really done in the physical markets, where the derivative markets dwarf it, like for example, nobody knows how much gold is in Fort Knox. Nobody knows how much gold is backing central banks. Bitcoin is an open transaction ledger and it's all public. So it is really easy to know. So if Bitcoin becomes, as Paul Tudor Jones famously said a few years ago, the fastest horse and becomes the global store of value, all of a sudden we have a real-time public transparent scorecard that measures the value of currencies that are backed by nothing like the dollar. So if Bitcoin grows into that digital gold valuation, then it will make it hard to print money without seeing the consequence of that monetary printing. That's what I mean by that. Right now, Bitcoin is well short of that. It would have to rise by a factor of 20 to be at that level. But there are people who believe that this is a possibility, and I think that motivates a lot of what's going on politically. There are those who want to kill it, quote, in its cradle, in order to stop Bitcoin from growing up and becoming that global store of value. That to be that scorecard, which will make monetary printing harder.
Well, the critical word there is if. If Bitcoin becomes a global store of value, how would it get there? Certainly the governments, a lot of governments around the world I've heard, wouldn't allow that to happen. Like you've mentioned, it's a direct threat on their ability to print money. Why would they allow that to happen?
Well, because it's gradual. It really is. It's really quite a gradual thing. If Bitcoin rallied all the way to 500,000 plus, it would still be slightly less market cap than gold. Gold has yet to demonstrate any ability to put a brake on monetary printing. So right now, Bitcoin is more of a curiosity for most of the people who are concerned. I think that you will see if it rises too high, at that point, there will be those who want to squash it. The issue is there critical mass? And the issue is it done in a incremental enough fashion to coexist until eventually it becomes the ability for people to opt out? And like Michael Saylor, I think that incremental likelihood is far more likely to happen. I don't think you're going to get a moonshot Bitcoin going to 500,000 and then the next year going to 5 million in order to replace all global currencies and getting to a Bitcoin standard. I think that it happens from the periphery in. So countries, we've seen El Salvador, very important news this week, El Salvador's bond rating being raised back, basically saying that when the rating agencies cut their bond rating because they adopted Bitcoin as legal tender, that's now been reversed. That's kind of a big deal. If you see more countries on the global periphery, not G7 basically, adopting Bitcoin as legal tender or embracing Bitcoin instead of dollar pegging, I think that you'll start to see that become a bigger trend over the next 5 years. And that's kind of the point. So if you're a policymaker in the US, do you really fear something that is going to happen when you're no longer in the job? And I think that's how they're looking at it.
What about the financial institutions? Why are banks like Citibank or JP Morgan, whatever the case may be, why are they not adopting the same strategy that Michael Saylor and Michael's strategy is, which is to put Bitcoin on their treasury or in their treasury on their balance sheet?
Regulatory pressure. I think that they don't believe they can without, if you're Citigroup, you're regulated. I mean, MicroStrategy is regulated by, I guess, the FTC or whatever. But if you're a big money center bank, you're regulated by the Federal Reserve, by the Office of the Comptroller of the Currency, by the SEC, by the CFTC, by the FTC. You also have the Treasury Department looking over what you're doing because you're a too big to fail institution. These people have enormous regulatory, compliance issues. And so the idea that they would ever invest in crypto on their balance sheet when we just saw and are seeing banks, for example, just the ability to have deposits from crypto holders, from crypto exchanges is considered to be risky. And the various regulators have said this. They call that risky. Directly owning it is definitely off the table right now. Now, will that be the case forever? Absolutely not. Is that the case today? Absolutely true. Is it the case in other countries? Well, that's an interesting question. I think you may very well see it as a treasury asset in the next 2 to 5 years, but it's going to start elsewhere. It will not start in the United States.
I want to come back to that and changing regulations, but would they want to is another question. Put yourself back in, let's say, a boardroom of Citibank where you're an MD and you're having a meeting with other MDs. and you're trying to convince them to do exactly what we're discussing right now, which is to put Bitcoin on their treasury, would they say, yes, this is a good idea?
I mean, treasury is for companies that are a bank where it will depend. The most important thing when banks look at treasury is capital requirements. So, for example, if you have treasury bonds, you take almost no haircut. That is considered good collateral for everything that you do. If you buy real estate, that is haircut dramatically. If you buy crypto today, it's haircut almost 100%. You almost get no value for it. So as long as the capital requirements as what's good collateral are the way they are, it's not even part of the conversation. Now, that's not true if you're an asset manager and you're recommending portfolios to your clients where you've recommended historically 5% in precious metals or something like that in what's called the 60-40 portfolio, whatever the nuance between bond and equity weights and precious metal weights and alternative investment weight. Bitcoin has yet to enter that conversation in a meaningful sense. And there's a lot of money there. That is where I expect to see it entering the conversation more and more. And it already is in countries outside the US, and it's starting to gain some traction in the US. But that's far more than what a bank can do, because banks will be the last place, and that's because of capital rules.
Okay, interesting. And do you ever see a scenario in which regulations shift in this direction such that banks will directly compete with Binance or Kraken or any other centralized exchange for crypto on-ramp?
Well, that's a phenomenally good question, David. I have to tell you. And the reason is because there are many conspiracy theorists out there that believe that what is actually happening from the US regulators is they are looking to try to shut down those businesses or make them scrap, such that the banks could then come in, which they have a tighter relationship with, and actually build back that sector. That is what the conspiracy theorists say. I'm not so certain that that's what they're trying to do. I think it's much more about jurisdiction. And I think that most of the really regulatory issues that we have today is basically a jurisdictional food fight between the SEC and CFTC and state regulators and federal regulators. And you see lots of me. It's almost like children playing on the playground is how our regulators are effectively approaching this. And I think the knock-on effect of that has been potentially to move in the other direction. The banks, just to go back to the banks, as you mentioned, yes, I had many years sitting as a managing director on Wall Street. The banks will go where they think they can make money, period. So they will always try. So you saw in 2017, when Bitcoin first started to rally, all the banks started up efforts to investigate crypto. And then when 2018 crypto winter set in, they shuttered or mostly shuttered those businesses and those efforts. And today, over the last few years, those efforts exist. I mean, pretty much every bank has some investments, at least, and has something going on in the digital realm, because they don't want to be knocked out of that realm. But those somethings are definitely less than they would be if it wasn't for the regulatory uncertainty in the US.
Bitcoin today is up. We're speaking on Friday, May the 5th. It's up about 2%, coinciding with the rise in the equity markets as well. Gold is down about 1.7%, which is a significant move for the yellow metal. It doesn't typically move very much on a single day basis. But the point is, do you think there will ever come a time when Bitcoin will move in tandem with gold and not so much correlated with the NASDAQ?
Well, actually, if you look over the last 3 months, it has been more correlated to gold than the NASDAQ, except for today. I think that there's a couple of long-term processes at play here. One is Bitcoin today trades like an option on its own future adoption. So I mentioned, just throw off some numbers. 20 to 25 is the times, 20 to 25 times appreciation is what Bitcoin would have to be to reach what I would call digital gold status, where it starts to approach the market cap of gold that is considered the monetary value of the metal as opposed to the jewelry value of the metal, okay, and the industrial value of the metal. That is a very big move. So effectively, Bitcoin trades like an option on its own future adoption. My favorite chart as to why I'm so incredibly bullish on Bitcoin, you can pull this one up thanks to our friends at blockchain.com, is the hash rate of the Bitcoin network on the same page as the price of Bitcoin. And you see an enormous divergence over the last 6 months. To me, that's a very big deal. And long term, that divergence will get fixed. either Bitcoin's price will start to rally or the hash rate will start to collapse. I believe the rally scenario is much more likely. But the real issue is, as gold over the period of 70 years demonetized silver because it was much easier, particularly post-Federal Reserve, it was much easier to trade in gold as the dollar started getting devalued. And everyone knows that since 1913, the dollar's lost 98% of its value vis-a-vis, just purchasing power. Gold demonetized silver. Gold and silver in the earth are at 15-1, basically, a ratio in the earth's crust. And that was a ratio that existed for thousands of years between the value of both metals. In the more modern state, over the last 200 years, that has gone away. And for the most part, gold's increase in value, even today, it's still within a couple percent of its all-time high. Silver is 50% of its all-time high. I think there are many of us that believe that Bitcoin will start to eat into gold's monetary value over time. As I said, it's 1/20th the SOP market cap right now. So you wouldn't even notice it in gold. And therefore they can move together for a while. But at some point, you might see an inverse relationship there again, but that would be at much higher price levels. But I do think that the store of value narrative for Bitcoin is important. And that's why over the last 3 months, we've seen it react more like gold and less like just a risk asset, even though it trades like an option, and even though 4/5 of Bitcoin volume is in derivatives and not in spot, which tells you a lot about where the marginal buyer can come from on any given day.
Just a real quick point on the hash rate, since you brought it up. What drives the hash rate? Hasn't it just gone up because of the mining difficulty increases? What's the relationship between the price and the hash rate?
Well, the mining difficulty increases certainly have an impact on hash rate, but the real thing about hash rate is who feels that a long-term investment in the ability to provide validation for the Bitcoin blockchain and the block rewards that they will get makes sense. And so it's extraordinarily bullish long-term in terms of the network, the overall ability of the network to process new demand. There are other metrics on the blockchain as well in terms of new addresses, transaction uses, the profitability of addresses, the amount of addresses that are long-term holders, indicating there's no real difficulty in supply in terms of investability for new investors, which means new investors will drive the price up. There are lots of metrics that people follow, but the hash rate is probably the single best simple answer for the health of the Bitcoin network. The easy way you can look at this is if you look at the chart over the last 4 years, you'll notice a massive fall when China banned Bitcoin mining, followed by a relentless monotonic trend upwards since that point. So since China banned Bitcoin mining, the strength of the Bitcoin network, its vulnerability to attack vectors has become, well, the vulnerability has gone down, the strength of the network has gone up. And that should be a leading indicator for price in a long-term lens. In a short-term lens, we're looking at a world where risk assets are under pressure because of rate rises. And so it's going to trade a lot like risk assets. Eventually, that delinking, I believe, will happen. I just think it's a bit premature at this point.
Final question, Dave. Let's put everything together. What is your outlook on risk assets for the remainder of the year? And what is your outlook for Bitcoin, since Bitcoin is related?
Right. I believe that between now and the end of the year, that Bitcoin will more and more delink from risk assets. I think that there is, and I do a show every week where I talk with Mike McGlone from Bloomberg. He is extremely bearish on the economy, thinking that the contraction in bank lending is going to be rippled throughout the economy, and that real economy is going to collapse or at least contract. I think that's probably right. The question is, what risk assets? Risk assets that see that, but understand that a new flood of liquidity will happen in. I wonder if this is a fool me once, shame on you, fool me twice, shame on me scenario. If you go back to 2008, the end of 2008 going into 2009, the economy was under severe duress. Liquidity had locked up, and the Federal Reserve started its program at that point to really try to bail out the economy. It took a long time, 3 to 6 months, before anybody who said that the stock market is going to recover from these levels would be listened to. I remember Tom Lee from Fundstrat basically being one of the only bulls in early 2009. turned out to be one of the greatest calls in history. And his reason was that the monetary spigots are going to open again. So what will that mean? Does the monetary spigots opening again mean that a company's discounted cash flows are going to be worth that much more when they're suffering potential economic carnage? Well, maybe. Some companies, one especially technology, I think you'll see more likely to hold in there than companies that are exposed to the real economy, if in fact that scenario of a recession does come to play. And that seems fairly likely. But for the same reason, I would expect its effect on Bitcoin in particular to be somewhat muted because of the inherent value of what it means when we believe that the monetary spigots are going to get re-engineered, and the money printer go burr narrative starts to dominate again. So I think that those two cross currents bear watching. There's also one other potential wild card that has to be said. The budget, we haven't talked about the debt ceiling. If the debt ceiling impasse creates a desire from the administration to, quote, mint the platinum coin, to essentially say, Congress, you can't control me, because that's literally the only card they have to play, unless other than hoping that the coalition, that McCarthy can't keep his votes together. But they've passed a budget basically saying hold spending at 2022 levels in order to get a debt ceiling raise. And that doesn't seem very extreme to me. So either the administration is going to have to agree to that, which would probably be bullish for the stock market and less bullish for Bitcoin, or the administration is going to play tough and try to pull out some version of brinksmanship. If they decide to mint that coin, I believe the symbolic impact of that will cause a massive rally in Bitcoin, at least. I don't know about the rest of crypto, but I think that that's the kind of thing that will signal a potential loss in confidence. And I think that that's absolutely worthy of being said, because it's getting talked about more and more as this progresses. But we'll know within a month, I think.
Yeah. Okay. That's interesting. I thought that was just a theory, but they're actually seriously thinking about that. Okay. The argument, let's close off here. The argument that banks are failing and therefore more attention and traffic and capital flows perhaps will go into Bitcoin. Is that just too simplistic an argument, or is there some merit in that?
Yeah, it's a bit simplistic, because I think what happens, banks are failing. The reaction to that will be more monetary printing, and therefore Bitcoin as the kind of the value divisor will get more. I mean, keep in mind, the market for Bitcoin is tiny. At $1 trillion, and with a float that's really small relative to that one, and it's not at $1 trillion yet, it's actually a little bit below, it's a small float. It wouldn't take much. One large sovereign wealth fund outside the United States that decides to make a 5% allocation of their portfolio to Bitcoin, or even at 2%, could potentially bring Bitcoin back to all-time highs. Remember, last year, Bitcoin was trading in the 60,000 range, which is double where it is today. And what caused it to fall had nothing to do with Bitcoin. What it had to do with was people had to sell collateral. And because of the failures of Celsius and Voyager and BlockFi, and then eventually culminating with the failure of FTX, there was collateral being dumped overboard, and it was what you could sell, not what you wanted to sell. So a lot of those people have started to reaccumulate what they had sold. But the fact is, there was no fundamental reason for Bitcoin to fall when this happened, other than the fact that it was the collateral that was liquid enough to sell. As that reverses, there just isn't that much overhead supply between here and all-time highs. I think at that point, we'll have to see. So what have I called for in multiple places? I've called for, I say we're in a trading range. We need like the 28-ish range and 32. The next range up is between like the 30, high 30s and the low 40s. And this is just the inverse of what happened a year ago. Basically, if you look at what could 23 inverse, basically eliminate or reverse all of the falls in Bitcoin, we're not talking about anything else now, from 2022, the answer is yes. And it looks like the macro scenario is constructive for that. Could it go beyond that? Well, that's going to depend on all the other factors that we've talked about. But I think it's worth mentioning that.
Finally, where can we follow more of your work? So CoinRoutes website. Yeah.
Right. The CoinRoutes website describes us as, if you are a serious crypto trader, and you are doing institutional values in the tens of millions of dollars per month of trading, we can save you money. That's what CoinRoutes is at. So you can go on our website, sign up. We'll have someone contact you and show you how it works. I personally am at Dave Weisberger 1 on Twitter, and Dave Weisberger on LinkedIn. CoinRoutes as well has a LinkedIn page and a Twitter account. And we've been putting out research recently. So we just sent out a piece of research on our blog, but we also sent it to our mailing list if you sign up for, talking about the liquidity patterns in the market and how we can measure the cost of trading second by second. So you can understand what liquidity really is and what the cost of trading really is in Bitcoin, which is something that is hard to find, weirdly enough, in the Bitcoin market. But
how do we sign up for this? How do we sign up for this mailing list?
Yeah, just go on coinroutes.com and you get a contact form, and that'll automatically put you on our mailing list, and you'll get our newsletter and everything else.
Awesome. I'll put the links in the description down below, so check it out. Twitter, LinkedIn, and of course the CoinRoutes website. Thank you very much, Dave, for your time today. Excellent, thorough discussion.
Thank you, David. I appreciate the opportunity.
And thank you for watching. Stay tuned for more, and don't forget to subscribe.